There is a playbook that gets executed before every market collapse. It is not a theory. It is a mechanical sequence that the wealthiest investors have followed before every major crash for the past 100 years. 3 specific moves. Always the same 3. And right now, as we speak, those 3 trades are being made again by the people who matter most. Joseph Kennedy made them in 1929. Paul Tudor Jones made them in 1987. Michael Burry made them in 2008. These weren't lucky guesses. This was pattern recognition. Crashes follow a script. Valuations reach extremes, leverage saturates the system, and the insiders quietly exit before the door slams shut. I've been tracking the flows. Warren Buffett is sitting on $325 billion in cash, the largest hoard in history. Central banks are buying gold at record rates. Hedge funds are loading up on volatility bets. The smart money isn't guessing. They are positioning. We are currently in the distribution phase, the moment where the whales sell to the minnows right before the storm. Let me show you the 3 trades that separate the victims from the victors. Trade number 1 is simple, boring, and absolutely critical. The cash conversion. This happens 12 to 18 months before the crash. It is the recognition that the math has stopped working. In 1929, Joseph Kennedy looked at the market and realized everyone was buying on margin. He knew that when the selling started, there would be no buyers, so he sold everything a year early. In 2007, Warren Buffett's cash pile grew from $40 billion to $60 billion. He told everyone, "I can't find anything to buy." Fast forward to today. Buffett isn't just holding cash, he is selling his favorite stocks. He cut Apple in half. He is dumping Bank of America. And he isn't alone. Jeff Bezos sold $13 billion of Amazon. Mark Zuckerberg is selling Meta. Jamie Dimon is selling JP Morgan for the first time in history. When the insiders, the people who see the real data every day, are selling at all-time highs, they are ringing a bell. They are converting paper wealth, stocks, into real liquidity, cash. They know that when the crash comes, cash is the oxygen that lets you survive the fire. Why are they selling? Because of the valuation trap. Markets revert to the mean, always. Right now, the S&P 500 is trading at valuations seen only twice in history, 1929 and 2000. The Buffett indicator, the total value of the stock market divided by GDP, is at 2 standard deviations above normal. Essentially, the stock market is priced as if nothing will ever go wrong again. But look at the concentration. 7 stocks, the Mag 7, make up 30% of the market. Nvidia trades at a valuation larger than the entire German economy. This is not investing. This is momentum gambling. The billionaires know that trees don't grow to the sky. They know that when the risk-free rate, Treasuries, pays 5%, paying 50x earnings for a tech stock is a bad bet. They are selling hope to you and buying safety for themselves. But sitting in cash has a risk. If the crash triggers a government bailout, they will print money. That brings us to trade number 2, gold accumulation. This trade runs parallel to the cash trade. It is the insurance policy against the government's response. In 1933, after the crash, Roosevelt devalued the dollar against gold by 70%. If you held gold, you got rich. If you held dollars, you lost purchasing power. In 2008, after the crash, the Fed printed trillions QE. Gold doubled in the years following. Look at what is happening now. Central banks, China, Russia, India, Poland, are buying gold at the fastest pace since 1967. They are preparing for the next devaluation. They know that when the debt bubble pops, episode 03, the only way out is inflation. Cash protects you from the crash. Gold protects you from the cure. The billionaires hold both, one to buy assets later, the other to preserve wealth now. Trades 1 and 2 are defensive. Trade number 3 is offensive. This is the profit trade, the volatility bet. This happens closer to the event, usually 6 to 12 months out. In 1929, Jesse Livermore shorted the market and made $100 million in a single crash. In 1987, Paul Tudor Jones bought put options and tripled his money in a day. In 2008, Michael Burry and John Paulson bought credit default swaps, insurance against default, and made billions. Today, we are seeing massive accumulation of put options and VIX call options by institutional investors. They are buying insurance on a house they know is about to burn down. When the market crashes, volatility, the VIX, explodes. A put option can go up 1,000% or 5,000% in a week. This is how the smart money funds their shopping spree at the bottom. They use a small portion of their portfolio, 1 to 3%, to make a bet that pays off 50 to 1 if the system breaks. The setup is in place, but what pulls the trigger? History tells us it can be anything, but it usually involves leverage breaking. In 1929, it was margin calls. In 2008, it was subprime mortgages resetting. In 2026, the candidates are everywhere. It could be the commercial real estate cliff, episode 04. It could be a Japanese carry trade unwind. It could be an AI earnings miss from Nvidia that shatters the tech narrative. The specific trigger doesn't matter. The forest is dry. One match is all it takes. Once the selling starts, it becomes mechanical. Algos trigger sell orders. Margin calls force liquidation. Passive funds, episodes of 6, sell blindly into a void. This creates a liquidity air pocket, where prices freefall because there are no buyers, except the billionaires who prepared. There is an implicit fourth trade that comes after the chaos. This is the ultimate goal of the playbook. When the market is down 50%, when the headlines say capitalism is dead, when your neighbor is panic selling, the billionaires deploy. They take the cash, trade 1, the gains from gold, trade 2, and the massive profits from volatility, trade 3, and they buy everything for pennies on the dollar. Joseph Kennedy bought real estate in 1933. Buffett bought Goldman Sachs in 2008. Bill Ackman bought stocks in March 2020. This is the wealth transfer. Assets move from the weak hands, who ignored the warning, to the strong hands, who followed the playbook. They don't buy at the top. They buy from you at the bottom. Let's summarize the investigation. The pattern is repeating. The smart money has already signaled the exit. You don't have billions, but you can copy the strategy. 1. Raise cash. If you are 100% in stocks, you have no bullets for the crash. Consider taking profits and building a war chest. 2. Own insurance. Allocate 5 to 10% to physical gold or Bitcoin, assets that have no counterparty risk. 3. Hedge. Learn how to use simple put options or inverse ETFs to profit from a downturn. Or just sit on your hands and wait. 4. Prepare your buy list. Know exactly what high-quality companies you want to own when they go on sale. The crash isn't the end of the world. It is the beginning of the next cycle. But you have to survive the drop to enjoy the rise. This is the smart money wisdoms. The future belongs to the owners. Thanks for watching. Like and subscribe. See you next time.